Well, so I would say the inflation has been as expected, if anything, hot, pretty hot. And I've been surprised, obviously, by the escalation in Europe. When we were talking a year ago, I would not have guessed that, on my 2022 bingo sheet, I did not imagine the level of conflict and war we have, on Russia going after Ukraine like that. Um, I would not have guessed for energy prices in Europe to skyrocket as much as they did. I would not have guessed sabotage on Nord Stream. So we certainly added some drama to this whole thing. Um, and it's funny, I've been a bond bear, right? So I remember like last year I would go on multiple interviews and explain why I don't like bonds. Primarily my focus was on real terms. I was like, I'm not even sure what yields are going to do, but especially in an inflation adjusted sense, I don't like bonds. And they've done even worse than I would have guessed. So they've hit higher nominal yields, much lower, much worse price sell-offs than I would have guessed a year ago. So even I actually, despite being a bond bear, I've not been bearish enough on bonds. And so I would say the extreme of some of the moves. So the surge in the dollar, the surge in the yields, the war in Europe, uh, you know, um, some of these
And
kind of
I
the
started writing
extreme
about
levels
bonds
of the
back in
moves, I think would
2019.
say has surprised me to some
In
degree.
some cases, a little bit earlier, and I had an article in the middle of that year basically saying, "Are we in a bond bubble?" And I went through the whole thing where we had $18 trillion in negative yielding debt out there. Magazine covers were saying inflation's dead. And I kind of reviewed this whole possible thing. I was like, inflation is something that in extreme environments, fiscal and monetary authorities, especially when working together, can generate, quite well if they get to the point where they need to. And, we got the catalyst the next year in 2020. And ever since then, we've been off to the races in terms of the amount of monetary expansion, at the broad layer, not just base money, but broad money expansion, more money in people's pockets. Then combined with various inflationary forces like energy crisis and kind of a reversal of some of these offshoring globalization trends, which keeps downward pressure on labor prices domestically. And so when bonds are yielding next to nothing and inflation is reaching 4-decade highs, I think it's natural for those yields to want to push up because they're even at these even after this crazy sell-off, those yields are still below at least current inflation. Now they're above forward inflation expectations, but forward inflation expectations has not been particularly accurate in recent years. And so I think it's a combination of one, trying to deal with the inflation, and two, some of it's mechanical. Some of it is, as central banks are trying to fight that inflation, they're trying to not buy as many bonds or even let some bonds mature off their balance sheet. And so now you have basically oversupply of bonds, large deficits, and then you have some of the biggest buyers not selling, and then, I mean, not buying. And then when you go to some markets, like for example, the US Treasury market, foreign countries use those treasuries as like a ballast for their own currencies. So when the dollar is weak, they're generally accumulating treasuries, and when the dollar is like very, very strong, like it is now, especially compared to many other developed market currencies. So ironically, some of the emerging markets are actually holding up better, but the dollar is very strong relative to a lot of these other currencies. And so what they do is, first they stop buying treasuries. And then two, they can start letting treasuries mature off their balance sheet. They can sell some of the shorter duration stuff that they have. And, if it gets bad enough, they could even sell some of the long duration treasuries. And so you have a lack of a foreign bid for treasuries. And so basically in this environment, it's a very toxic combination for the sovereign bond market. I would say that, yeah, again, going back to 2019, I was saying that, whatever excess there is in equities, I was more concerned about the bubble that's in sovereign bonds because when you have, for the first time ever, like negative yields, or in the United States, like record low yields, and I was at long horizon, I was seeing inflationary pressures, possible to start building. It's just a toxic combination, and it's funny. It surprised even me with how rapidly it happened, and part of that is because we got certain it's failed.
catalysts
I
that
mean, the bond
there were
market
even
is
I
more
mean,
rapid
equities,
than
if
we could
anything,
have
have
gotten.
been
Like
more
again, the
accurate than
energy
bonds in the
crisis in
past few
Europe and the
years.
war in Ukraine.
Um, and I think it's that's kind of common at major trend shifts, right? So, uh, you had 40 years of kind of structural disinflation. And you had periods of inflation in there, like the 2000s decade, but you still had a structural disinflationary trend. So we had structurally falling interest rates, higher and higher debt relative to GDP, globalization.
A lot of these were these, disinflationary forces. Aging demographics, for example, in some cases can be disinflationary. There's actually some nuance there that they actually can be inflationary in some cases. But we had a 40-year period of kind of like the great normalization, the great disinflation, and kind of my contention is when we run into the next issue back then. So I was saying 2019, when we run into the next problem, there's not a lot of wiggle room here, and so we're probably going to get some more inflationary types of fiscal policies. And then also when you look at the kind of the long-term commodity cycle, right? So there's periods of overinvestment, there's periods of underinvestment. Uh, some of these longer-term projects take many years to come online, so there's kind of a natural rhythm to commodity markets. And what I would generally see when I looked out on research is I would see very siloed research. So I see, the people making disinflationary calls, they're not talking about energy capex at all, right? It's just completely off their radar in many cases. And then you go in other areas and say they're not very familiar with bond market dynamics or things like that. And so when you kind of put some of those pieces together, it just wasn't a very attractive situation for bonds. And then furthermore, even going back, say, 40 years, the type of inflation we had this time is quite different than the 1970s inflation. So a lot of people that were kind of when they were determining whether or not inflation is going to happen, they were looking at the 1970s and saying, well, we don't have those conditions, so why would we get inflation? And it's like, well, go back to the 40s and you'll see why we were going to get inflation. And so that was, in my view, the 1940s were the closest analog. And the big difference there is that in the 1970s, inflation was in large part coming from peak demographics. So baby boomers entering the workforce, buying tons of homes, a lot of banks lending, and therefore a lot of money supply growth from banks lending. And a lot of people said, none of that's happening, so we can't get inflation. And it's like, well, the other level of inflation is like the 1940 style inflation, where you have absolutely massive government deficits that are monetized and supported by the central bank. It pours money into the economy, goes around the banking system, or in Russell Napier's view, it supports the banking system, but you can also just go around them pretty much, and it just puts more money in people's pockets, and then you add it's basically wartime finance. And so in 2020 and
Mhm.
2021, we had wartime finance in response to lockdowns and things like that. Basically, if you just showed me charts of what was happening, it looks like a war. Um, and of course now we have actual war, which is also inflationary because it's malinvestment. It adds frictions. It
Well,
reduces
so there were a variety of
productivity. It
periods throughout that
reduces
time. So
global
they
efficiency.
actually didn't
And so
fully
this
let
is a, this
go
is a very
of that
inflationary
financial
cocktail.
oppression really until the early 1950s. And it was actually
Mhm.
that's when it became a political struggle because you had the Fed wanted to get independent again. So during the war, essentially the Fed lost independence more or less, and they wanted to reassert that independence. And the Treasury's like, well, not yet, not yet, not yet. And so you had this environment where they were still running this kind of inflationary playbook and they were still holding yields lower than the prevailing inflation rate. And eventually you had a separation. But that took several years to manifest. And there were kind of the year by year playbooks, what was happening each year. But essentially, I when it comes to analogs, I try not to match things up year by year, right? It's more about the
Mhm.
broad paintbrush, right? So obviously technology is very different than the 40s. The type of, the reason for the financing is different than the 40s. The political environment is different than the 40s. I've often said that the U.S. today looks more like the U.K. of the 1940s, which is, the incumbent power and the structural trade deficit power, whereas back in the 40s, the United States had a structural trade surplus. And so
Mhm.
there are things that are different than that environment. But the short version is it's kind of like a Hotel California where it's very, very hard to get out once you get into the situation. And one of the basically the reason they were able to get out back then is because they didn't have that demographics problem. They didn't have that top heavy basically entitlement program. And so after the war was over, they were able to start getting a handle on the budget. They were able to start, federal debt never went down nominally in any significant degree, but they basically managed to hold it flat for a number of years as nominal GDP, partially from real growth and partially from inflation, caught up to it essentially. So you lowered the debt to GDP that way. And the problem now is that we're still running, in the United States, $1 trillion deficits with no end in sight because it's in addition to these kind of one-time programs, we also have this background overlay of $1 trillion deficits that are largely due to our structural budget issues. And then that's, you can look at Japan, you can look at Europe, parts of Europe, and it's kind of the same problem. And now Europe has an acute energy crisis, which is kind of like a wartime situation. You have a national security issue if you can't produce things at reasonable prices compared to the rest of the world, and if people can't afford their heating bills and can't afford to keep the power on, and you have some degree of demand destruction from companies shutting down. So in many cases, this continues to resemble the 1940s, and I think we're probably still in the early 1940s. If anything, I think we're still, the war's not over yet, right? So this is not like 1945, 1946. This is like, wave one, I think, of this dilemma. I think the war ends when the energy supply situation is more resolved and some of these geopolitical things are more
That's
resolved.
a good point.
And
For
then
the
probably
first
also when you've
couple of years
inflated
here,
quite a
we've been
bit
kind
of
of
the
running
debt
the
away,
1940s
which
playbook
is I
pretty
think we're
closely.
nowhere near
Now,
doing.
kind of Powell doesn't want to be the fall guy for this, right? So now he's trying to run the 1970s playbook.
The problem is that when Volcker did that playbook, the United States has 30% federal debt to GDP, and lower private debt to GDP. And, by the time you got to the end of the 1970s, you resolved a lot of the underlying energy supply shortages, right? So it wasn't just yeah, Volcker gets all the credit, but it was also those underlying forces were more resolved, right? And so the problem now is that, basically, is there any relief structurally on the energy supply side over the next few years? And I would say no. There's not a ramp up in capex. There's short-term band-aids. So, for example, the current administration is drawing down the strategic petroleum reserve to add excess supply. China's been doing rolling lockdowns for 2-3 years now. And so they've been below total normal flight capacity, driving capacity. So they're reducing their fuel usage. So we have these kind of like forces that are kind of keeping the lid on energy to some extent, at least outside of Europe. And the problem is that a lot of those are kind of temporary, and it's only resolvable by actual new supply coming online, and that's not really happening. And then ironically, by raising rates, you suppress demand to some degree, but you also increase the cost of capital for those energy companies, and so the hurdle rate for their investment, especially in longer term projects, is now higher. Um, and so I think that the kind of the end game here. So we already see Japan's running the 1940s playbook, right? They're full capping yields. It's actually even lower yield cap than the 1940s because that was 2.5%. This is, 0.25%, which I think is too low, but that's the level they chose. So they're running a 1940s playbook. The ECB is doing spread control, where they're trying to support Southern European debt from blowing out. So there's some degree of yield curve management happening there. And then we know with the Bank of England, again, they're not doing formal yield curve control, but they jumped in when the market actually broke. And so I think the Fed's kind of in a similar boat where, they can tighten unless or until the treasury market breaks in the similar way that gilt market broke or something like that. So as long as the treasury market remains intact, they can be somewhat independent. They can run the Volcker playbook. They can tighten. They can try to increase unemployment. They can do the strong dollar playbook so that in addition